All right, all right, all right. Freedom Venture Investments, Dave Seymour. This is a great phone call for me. Great opportunity to bring in secret sauce, if you will. We've talked a lot about what's going on in the marketplace. Why is the absolute best time now to be investing in real estate? Why is the best time now to be investing in multifamily? Why is the best time now to be investing with a fund like ours? So I've been able to pin down my business partner, Walter Novicki. I've got him on the line. I'm going to grill him on a few questions. You'll get an opportunity to meet him face to Zoom, I guess this is. And we'll just spend maybe 10, 15 minutes together, answer some questions, get some insight to the real plan that we have in place to create wealth, create better returns, targeted returns than most other vehicles out there in the marketplace. So, Walter, are you there, buddy? Can you reveal yourself?
Here I am. How you doing, David?
Oh, good, man. Oh, good, Walter. Pleasure to see you, my friend. I know you've been grinding down there in Florida the past couple of months. So, look, these folks that jump on these calls, you know, a lot of them know me. I'm famous, Walter. So a lot of them are familiar with my story and who I am, but do me a favor, man. Talk a little bit about, you know, what you've been doing, your career. I've always been proud to say you're my partner. I'm proud of your military service, and so thank you for that. But share a little bit with the folks here as to how you got into real estate and what you've been doing down there in Florida, and let's just go from there. Qualify yourself, young man.
Not a problem. Yeah, Dave, I've been involved in the real estate market since 1986. Actually, while I was still in the military. You know, my last duty station was a little campus called Ohio State, Columbus, Ohio. So had the opportunity to actually start looking at investing through a friend of mine, gentleman who had left the military a little bit earlier and had some good fortune investing in campus housing. So he brought me in and we started co-investing. One thing led to another, and within a few years, you know, we had amassed about 168 rental units between Ohio State University and Otterbein University. So that's how I got my start. Progressed into the financial industry as well as continuing to grow the real estate. Started a company called Midwest National Mortgage, became a very large regional wholesale mortgage company, and grew that company up until 2004. Now, while I still had the mortgage company, I saw some opportunities developing in Florida. We had actually opened a retail branch down here, and I saw that, you know, the industry was starting to heat up. And I was looking at appraisals, and it was amazing me. New construction properties, you know, a guy was writing a contract for a new construction house down here at $120,000, which was a steal compared to the market I was in Cincinnati. But what amazed me was 6 months later when he went to actually close on the house was worth $200,000. So yeah, you know, everybody knows what was happening in the market there.
Sure.
So you know, I decided to actually come down and you know, put boots on the ground, my boots, and that's what I did. I actually started to build some infrastructure here. Started a company by the name of Ideal Development, which was a general contracting company, because I figured, hey, I could build these houses for 120 and have them go to 200,000 as well, and that's what we did, and we grew that business in this area. Started to make a transition, though. We started seeing some changes. You know, everybody saw it on the national level, 2007, 2008. We actually started to see the change down here about 2006.
Okay.
We started to see the market start to shift a little bit. We started to realize that, you know, maybe we were priced a little bit higher than what we could sustain, and I started to pull back. And I sat on the sidelines for about a year and a half, 2 years, waiting for that other shoe to drop, and it dropped. It dropped nationally, you know, 2008, 2009. We were blessed. We were in a position at that point where we had capital. Reached out to some other people that I had, you know, identified and built relationships with during the boom times. We actually pulled together a pretty substantial amount of capital, about $125 million. And what we did is what we started to do is go out and acquire waterfront properties. It was a strange market down here. I watched it go up. I watched these $100,000 lots sitting along a canal go to 200,000. 300,000, 400,000, 500,000. And then I watched them start to go the other way very, very quickly. what we did is we actually started acquiring prime piece of land, some acreage, most of it single family buildable lots or multifamily lots along waterfront communities throughout Southwest Florida. And the reason we did that is we knew that there was inherent value. They're not making more waterfront property.
Right.
And we waited. We sat and we waited. 2015, we actually liquidated that fund, and myself and my investors were able to enjoy an internal rate of return well in excess of 20%.
Wow. Wow. So let's dial it all back. All right. That's a pretty powerful CV, as we call it in England, curriculum vitae. You just call it what do you call it over here? That's your resume.
A
right?
resume. There you go.
Resume. So 1986, that was the year I actually emigrated to the States, and you were already playing. And then you followed that natural progression, and you raised over $100 million for that strategy that you deployed going into on the back end of the crash, correct?
Correct. Just barely shy of 125 million.
So let's bring it back to some fundamentals, because I know the answers, but not everybody else pays attention. Look, we deal with accredited investors, Walter. We deal with, intelligent investors. They've got some capital, some depth, some understanding. And I hear it consistently. Why do I want to be in real estate when I can be in the stock market? I can, do a little day trading. I can just double down on my 401k with company match. I look at my quarterly report. It says I'm earning 8-9%. Why do I want to play around with real estate?
That's a good question. I hear it as well. I mean, there's nothing wrong with the equities market. There isn't. You can make a lot of money. We've seen people do extraordinarily well. I've been around a few years, got a few gray hairs. I've also seen a lot of people lose a lot of money. I'll share a personal story with you about why I personally own zero in equities. Little company called Boston Chicken. They tell you to invest in things that you know and you love. I have a friend of mine, he's still a friend. Even after this story, he's still a friend. And Rick came to me and said, hey, he said, I just started this new brokerage. I'd like to bring you on as a client. And I was like, great. What do I invest in? He said, well, invest in things you like and love. Well, at the time, there was a company called Boston Chicken.
Yeah.
Later became Boston Market.
Yeah.
My wife and I loved it. The kids loved it. The place was packed. Drive-through line was always around the building. I was like, there we go. I'm going to buy Boston Chicken. So I bought Boston Chicken, and let's see, we're talking probably 1994, 95. Took a position with Boston Chicken at about $10 per share.
Yep.
Well, within about a 6 period of time, that wonderful $10 share investment dropped to below $1. Boston Chicken had some problems. They had expanded apparently too quickly. They had supply problems. They had management problems. There was all types of issues. And I still remember the day that Rick called me and said, hey, they've suspended trading on Boston Chicken. I was like, I wonder what that means. Tell me, does that mean that they're going to send me my money or what happens? He said, no.
I get all my money back, right? A money back guarantee.
He said, no. He said, it doesn't exist. And I said, what do you mean it doesn't exist? He said, your stock has gone to zero. Now, that left a mark.
I'm sure it did. I'm sure it did.
It still sticks with me today. Now, fast forward to 2008. 2008, I personally owned a lot of rental properties in Cape Coral, Florida. Mm-hmm. Cape Coral, Florida, and Las Vegas, Nevada used to compete every single week for the number of defaults and the number of foreclosures when the market was crashing. We had an 85% drop in property values. If you don't believe me, Google it, because when I say the number, it's hard for me to believe. Even though the market crashed, every one of my properties stayed intact. And what I mean by that, they didn't disappear like my Boston Chicken stock. Right. And as long as that asset's there and capable of producing income, there's value. So when the market came back, I was able to recapture basically what I had lost. I was made whole, and I had income during that period of time. And the crazy thing was that, believe it or not, even though the economy was going down, my income on that asset was actually going up.
Mm.
Unfortunately, people are displaced from their homes. They need properties. You have a limited amount of properties available for a growing population of potential renters. So market forces come into play, rents go up.
One of the guys who was a mentor to me earlier on, he used to say to me, invest in what you understand, right? You
Absolutely.
understood chicken, right? Like we understand a nice chicken with some mashed potatoes and a little gravy. But I personally, like you, I'm not in any markets. I'm not there because I don't understand it. I don't understand how something can have value, be tangible one day, and intangible and just liquidated, in a very short period of time. It makes no sense to me. So
Right.
I like you understand that concept. I didn't have the pain factor with it, but I definitely, I definitely understand sticks. I always talk about sticks and bricks. If I can't touch it, if I can't feel it, if I can't smell it, if I can't paint it, if I can't, right? It doesn't, it's not tangible. It's not real to me. A friend of ours, and I don't know if you appreciate this, he said, I don't care what happens to the rest of the world. I'm always going to be in real estate. Even if we're flying around in space cars and all we have are little pods, right? You remember this guy? He said, even if we have little pods, I'm going to have the very best pods out there at the very highest rate of return. And I'm going to use other investors' money to buy as many of those pods as I can. Go. So I understand that. So that was single family in Florida.
Correct.
And
Correct.
It took a beating. Now, today, you and I and our partner, Eric, we invest in multifamily assets. So let's hit that one a little bit, because I get that all the time. Why do I want to be in a multifamily arena? Why take on all the additional headache, pain, challenges, misery, right? For some people on a 100-unit complex. Why do I want to get involved with that instead of buying single family houses? Why don't you open that door for us, Walt? What do you think?
Absolutely. I mean, I'll take it back a step further. I mean, the decision has to be made. Do I want to do, commercial, or do I want to do residential?
Residential.
I look at multifamily as a blending of both. Okay, it's a large cap asset, yet it is tied to the residential market, and people are always going to need places to live. It's economy of scale with apartments. One building has one roof. Okay, it just is economy of scale. What we're seeing in the Gulf Coast region of Florida takes it a step beyond. A lot of people come and ask a question even more involved in what you're asking, and they say, okay, if I've made that commitment to some type of multifamily, why not build condos?
Yeah.
Build them, sell them, be done with the asset. Why take on the management aspect of it? A couple of reasons for that. One, we want the flow of income. So we want income production. And, if I build a condo building and I sell it, the income ends. It's a one-time hit. Whereas with multifamily, it's continual flow of income. But the big thing comes down to demand, Dave. We are seeing something that is unprecedented and was, for the most part, not predicted by even the people that are way, way, way smarter than we are.
Who could?
Yeah. The people that are coming down here, the people that we knew, baby boomers, were coming down here. That was projected, we're going to hit the year and 10,000 people a day are going to retire and 1,000 of them are going to come to Florida. That's happening. Hold on a while. I've got
that flyer that we work from. Let me pull that up on the screen.
Absolutely.
Because I think it's important to take a look, because once you start playing in this sandbox, in a grown-up sandbox, well, now we're talking about data being driven. So this is what Walter's referring to. This is just a quick snapshot of why we like Florida and multifamily. So break it down a little bit, Walt.
Yeah, well, if you look at our population, number one, even though we're leading in retirees, our population's growing younger. And a lot of people are trying to get their heads around that. It's really simple. For every person that comes down as a retiree, so let's say that 60 plus, they're creating job opportunities for 2 other people that are service related. Those people tend to be younger. So we're getting a lot of younger families that are moving down, having kids, taking advantage of, the beautiful environment that is Florida. So we're getting that younger population. We're also getting a far more educated population. as time goes by, we're actually attracting more and more tech people, people that are telecommuting. They can live anywhere in the country. My neighbor, for example, he has an engineering firm. He did away with his sticks and bricks. Now, he has consulting engineers all over the country. He said, "Hey, I can live anywhere. I want to live in Southwest Florida," and moved down here a couple years ago. So we're getting that younger, more educated population. And job growth. As the retirees are coming down, they're creating opportunities for job growth. So, going from 2017 to 2018, the 2019 numbers actually moved us up to number 5. So, we're actually improving as far as job growth. Top 10 figures, the I think are very important, especially in a changing economy. We're in the top 10 of places to start a business. Okay. We're in a top 10 position to grow a business. We're considered one of the most business friendly states. So when you have those types of advantages and you have these types of demographics and an expanding population, it shows why Florida is the 5th fastest growing state in the union right now.
Let me stop you a second, Walter, because there's a 1,000-pound gorilla in the room.
Sure.
Right? And it's called COVID-19 and the pandemic. This data is looking pre-pandemic. Yep. How does that play in? Because I know we were discussing it on our partners meeting this morning. How the pandemic really is an opportunity, as brutal and as sad and as horrible as it's been. It's also created a lot of opportunity. Why don't you expand on that a little bit and how those numbers play in as well?
Yeah, absolutely. I mean, everybody's being impacted on a nationwide basis, but what we're seeing here, in Florida, we have a lot of folks who have come down and invested in properties. We call them mom and pop operators. They come in and, maybe they pull some family assets and they buy a 20 or a 40 or 100 unit complex, and they put a management team in place. These are people that are not positioned to take any level of hit. Mm-hmm. Most of them, unfortunately, paid premium dollars for what they had. And as long as that asset's producing, as long as it's at 95% occupancy,
it makes sense.
They're doing well. They're getting a good stream of income. What they're starting to see, though, is that occupancy rates are dropping, and more importantly, collection rates are starting to drop. Now, fortunately, in Florida, we haven't seen that big drop yet because we've had the federal government subsidizing our state unemployment.
Yeah, but hold on a second. What happened today? Because
13 weeks went by pretty quick, didn't they?
They went by real quick, didn't they?
Yeah,
they did.
So that subsidy is now gone. As we move into our collected rents going into August, we're going to see people that have still been displaced that are, needing those funds. They're going to be making some tough decisions. And, sometimes rent isn't the first decision that they want to prioritize. So what that's going to do is it's going to suppress the rent rolls a little bit. The big operators, the guys that are managing thousands of units, they have reserves.
Yeah, they got reserves.
They got reserves. Their debt coverage ratios. I was just talking to somebody in banking, and he was telling me, the average portfolio. This is somebody that services billions of dollars of loans down there. He said our average debt coverage ratio is about 2%. Is about 2 in comparison to these mom and pop operators are at like 1.2. Bottom line, what that means is when they drop below that 90% threshold, they become a non-producing asset. They're not making enough money to cover the overhead and to make that debt payment. People are starting to see that. They're starting to become concerned. I mean, my phone rings on a daily basis from operators saying, "Hey, can you help me?" Bottom line, what it's creating is we talked earlier about, Q4, Q1,
Yep.
It's going to be a prime acquisition time for the people that are properly positioned.
I want to just make sure that that point is clear, because the big boys, as Walter refers to them, these are the larger, they're called REITs, real estate investment trusts, and they may very well be trading out, you know, in the stock market. They're not a private trust, kind of like we are, a private equity firm. But what they do is they will step over these 60 to 120 unit apartment complexes. They just step over those. They don't meet their buying criteria purely on that alone. And this was really a key indicator for us, right, Walter? I mean, we
Absolutely.
looked at that, and it's your wheelhouse. So I've every investor that I've talked to that's lining up to invest in the fund, every single one of them that I've talked to, they said, why don't you go big? Why don't you buy in the bigger units? And I explained to them, I don't need to compete with those guys, because what we're going to do is we're going to buy on the numbers that are actual at the time of negotiation. And because, unfortunately, as we refer to a mom and pop, or I think it's less professional. We're professional, qualified operators, right? We know this business inside out. We anticipate every single thing that can potentially go wrong. You know, in the fancy financial world, they say hedge the downside, accelerate the upside. Right? What that basically means is don't lose money, make money. And we've proven that. I mean, we've proven it as individuals, we've proven it as a fund. So that's why we focus on that area, because it's absolutely an opportunity. So here's another one that I get, Walter. You have been incredibly proficient at what's called a syndicated deal, where you bring in a group of investors. They make up the gap between what the bank will lend, 30%, 25%, whatever that number is, maybe 20%. So you raise that amount of money, and then all the investors go in on that one deal. And you've succeeded in that. However, I know a lot of investors who have not succeeded in that because of the asset class that they've got tied into. A lot of friends have got hurt in the retail world, for example. Whoever thought that the strip mall would go? Whoever thought that we'd never go shopping? Whoever thought we'd never go to a restaurant? I've watched some of the national chains locally. We were talking about Brooks Brothers, right? That's where guys like us go to get a little suit and put a little flag in the jacket. You know what I mean? Brooks Brothers is gone. It's a Massachusetts manufacturer. It's done. It's over. It's gone. Some of the local restaurant chains that were up here have gone. So, you know, whoever thought, and it goes again to our point before, you know, we stay with the multifamily. So my question to you is this: why should I go in with guys like you on a fund where I'm just investing in shares, or put all my eggs in the one basket of a multifamily on a syndicated deal? So one deal, or big fund, multiple deals.
Sure.
Why?
Yeah,
do they give the same returns? Are there better projected returns? I mean, why, Walter? Why?
No, that's a great question. If you actually compare the two, you're going to find varying degrees of returns. You know, and everything's risk adjusted. We're a core plus fund, so we're buying quality assets that are producing at the time that we purchase them. They just need to be tweaked. They need our expertise. They need the team that we bring to the table to take them from where they are to where they can be. And, you know, there's a certain level of return that's expected with that. The major difference is diversification. If I'm buying one asset, and I don't care how good an operator is, you're never going to be 100% of the time. It doesn't happen. That one time that maybe you misjudge a market, maybe you overvalue an asset, maybe you just buy at the wrong place at the wrong time, and there is any form of downside. If it's one asset in that basket, that whole pool of investors, they go down with the ship. Whereas if I'm buying into a fund that has 50, 75, 100 different assets within it, that one potential, drop, it's mitigated by everything else. So my total return is going to be impacted, but minutely. Small impact because it's spread over a lot of assets, as opposed to maybe a small loss on one asset is something to take you out of the game.
I remember you called me. We were probably a couple of weeks into into COVID becoming a topic, right? It was right around that period of time where certain people were saying, it's just a fad, it'll go away. we heard some of that stuff. And we're not going to play politics, but we are going to use some intelligence. And the intelligence, I remember you called me up and you said to me, Dave, I can do these things one at a time. And then you said, it's the opportunity in front of us is, and again, we all use the word, it's unprecedented. Whoever could have predicted that the COVID would be what it was and the impact that it's had. And then you said to me, I remember it kind of cheesy, but you said it's time to go big or go home. And in the sense of, right, and in the sense of, I know how good you are, Walter, at underwriting. I know how good you are at working your relationships and getting the very, very best deals dropped on your desk before anybody else's. Like, I know that. I've seen it firsthand. And I remember you saying to me how excited you are at having a $100 million checkbook, because now you can buy with intelligence, but now you can take everybody else out of the game in the sense of the speed with which we can move. And I'm no longer competing with those big boys going forward. So look, dude, I'm excited, Walter. I'm excited for a number of reasons. Obviously, you know, guys like us, and Eric, our partner, our younger partner, right? He's more than half of our ages. Like he's 20, 24, 25 years old. But that skill set and the excitement between this side of the equation is it's electric. Boogie, woogie, woogie. You know what I mean? It's like, I'm excited. And here's a couple of reasons why. One, again, the opportunity. Two, the fact of the team that's in place. You know, if you can, you know, you take it into any sports arena. If you do the, you know, the, what is that football thing where you can choose all your own players? What's that called? I just had a mind blank.
The
fantasy. Your
fantasy football. Right. Yeah, there you go.
If I could play fantasy real estate, right? I've got all the best players. You know, I got the #1 fantasy commercial real estate investing team for the league in which we choose to play, and that is exciting for us. But here's the other side of it. I'm excited for what we can do for the investors, because we know there are billions of dollars that have come from where they are, a number of different places throughout our economy, but it's all sitting on the sideline waiting for us. And, you know, we're here. We're ready to go. If anybody's watching this, there's somewhere, I'm sure Eric will make a connection where you could grab more information. Do your due diligence. Understand that you're investing with us. You're investing with us as operators. As the fund grows, we invest alongside you. Full transparencies, integrity, we are available. And for all of those reasons, you know, Q1, 2, 3, 4, and Freedom Venture Investments Real Estate Fund 1 is it's going to make its mark, that's for sure. So, Walter, I appreciate you, brother. Thanks for your time. Get back to your underwriting. Go find us. I got some more money coming, so you got to go find some more deals for us, brother.
I'm on it, Dave.
All right, man. Take care. Talk to you soon.
Bye. Bye-bye.